Hi, I'm Jimmy. In this video, we're looking at how we can juice up our dividend portfolio to essentially create dividends using covered calls. So this video that I'm showing you is going to be a clip from our weekly investing live stream we do on our private investing community where we created different investment portfolios. One of them is a dividend investor. We're picking different dividend stocks. And then in this case, we're going to write some covered calls on some of those dividend stocks to essentially help us create even more dividends. Now, our investor, his name's James. He's just started his portfolio, owns some ETFs, owns some stocks. One of his stocks, Intel, he wants to write covered calls on to juice up his returns and give himself even more income. Now, we're using a real life example from just last week, just a few days ago, essentially. And we're going to run through how to do it, our thought process for why we pick the numbers we picked, and how we can limit our risk and really use this to protect our portfolio and add additional returns every quarter, every month, every year, however often we wanted to do it. So if you're interested in joining our private investing live streams, I will leave a link in the description below to our Patreon page that is essentially the gateway to get into our community. So if you're curious, if you join, I will see you over there. Otherwise, let's jump back into the video right now. Here's basically how our investor is using the call option to help juice up his portfolio. So James, our investor here, owns 101 shares of Intel. He bought them at $49.41. That was yesterday's close, by the way. So he bought that at yesterday's close. Intel pays a dividend of about 35 cents per share on a quarterly basis. That's an annual dividend of about $1.40. Now, yield on cost is 2.83%. So their dividend yield, based on the price that they paid, is about 2.83%. Now, we actually did a video explaining yield on cost a bit more. If you're curious, we'll post that video up on the Discord in the live stream channel. But basically, it is what is the dividend yield that you're receiving based on the price you paid. Now, he decides the reason he bought as many shares as he did, our investor here, he made Intel 10% of his portfolio, which is frankly a bit high considering all he's got is other ETFs. I would have gone smaller. I think 5% would have been a more reasonable number to go with, but he needed to cross 100 shares in order to sell a covered call. So he bought enough to make sure he got over 100. He owns a bit over 101 shares. That then brings us to which covered calls should he buy? The first decision we had to make was, what is our expiration date going to be? We elected to go with the expiration date that expires 87 days from now on January 21st of 2022. We did that because first thing I did was looked out about a month. We wanted to buy options that had a strike price of about $60. That is down here. $60 strike price. Well, the $60 strike price next month was only paying, we were only going to get about 3 cents per share. 2 months from now, we're getting about 8 cents per share. 3 months from now, we were getting right here, 16 cents per share. Now, what we are doing is we are writing that covered call. So we are receiving 16 cents per share. Those are terrible colors. We are receiving 16 cents per share for the option that we sell.
Now, let me interrupt you.
Yes.
For the person that's not entirely read into covered call, what exactly we're doing here, and correct me if I'm wrong. We're offering to sell our stock at $60 a share sometime within the next 87 days. And in order to buy that option from us, the option to buy our stock at $60 a share sometime in the next 87 days, you're going to pay us 16 cents a share.
Exactly. So basically, what we do is they will pay us. So we collect a premium. That's what they call it. They call it that premium. That premium is the 16 cents. So they say, we want the buyer of the option. We're the seller. They're the buyer. We sell one option. They say, we will pay you 16 cents per share All right, so we got 16 cents per share for them to have the option to buy our 100 shares, these shares, at $60 per share. Now, for us, we don't really mind because we paid $49.41 for it. So they're paying 16 cents per share. Now, the reason this helps us as James, who is our dividend investor, is we already know we're receiving $1.40 per share from dividends. Yield on cost is 2.83. This 16 cents is for this quarter, going out the next 3 months. If we did that same thing for 4 consecutive quarters, well, that would be 64 cents on an annual basis. 64 cents plus the $1.40 we're receiving is, what is that, $2.04. That $2.04 on the same $49 that $49.41 that we paid for the stock, we now have essentially a new dividend yield on cost of 4.13%. So we basically manufactured our dividend. We created the dividend to go from 2.83 to 4.13. We picked up, more than 1% in dividend by doing this strategy. Now, the real question is, what is the risk? Well, the risk here is that what happens if tomorrow crazy news, good news comes out about Intel, and the stock goes from $50 a share to $100 per share. Well, sure enough, whoever bought that option from us is going to take that option away. They're going to buy the shares because for them, they have the right to buy the shares at $60. So they give us these $60 per share. In that case, because we paid $49.41, we make $10.59 in profit because we sold our stock at $60 per share. The fact that the stock is at $100 at that time or $60.01 is irrelevant. We're selling it for $60. They have the option. We don't. They do. We could always sell the option, but let's just imagine we don't. Well, we get $10.59 in profit. We also get to keep the 16 cents that they already gave us. Well, that means that we get 21.76% is our return on this stock. Now, that is under the scenario that we were able to, that the stock goes through the roof tomorrow and we sell it tomorrow. Our returns would actually be better than that if we got called out of our position towards the end of these 87 days, which is frankly, if we were going to get called away, usually do it at the end. Most investors won't call it away early because there's time value of money that you're giving away, so it doesn't make a lot of sense to do that. But point is, if we don't call it away, if it doesn't get called away tomorrow, I think November 2nd, November 3rd, there's an ex-dividend date for Intel. And in that case, we get another 35 cents. Add that 35 cents to our 16. Our return, if it got called away by the end of this, at the end of this 87 days, would actually be about 22.5%. So again, we pick up almost another 0.5%, almost another 1% in return once the dividend comes in. The real key to this, though, is why did we pick $60 per share as our strike price and not $57.50? Or not 55 or 50. If we did 50, well, we could have sold it. We could have picked up $1.39 per share. Well, I actually like Intel. I think Intel will do well. That's why we bought it. I think it is a good value, and I think it's very possible over the next 87 days, it is above $50 per share. I don't want to lose the shares. James doesn't want to lose the shares. He wants to keep the shares. I think $57.50 is borderline. I was on the fence between $57.50 and $60. It could have gone either way. But because we want to keep the shares, I went $60 to make it more unlikely that that Intel's going to get there by the end of this time period. I don't think Intel's going to get there over the next 87 days. It could, but I think it's less likely than if it would get to $57.50. So I'm willing to take, instead of 24 cents per share, I'll take the 16 cents. But the magic to this whole thing is that let's imagine at the end of the 87 days, the stock's at $55 per share. Doesn't get to $57.50, doesn't get to $60 per share. Option expires. It's at $55. Option is gone. The contract goes away. Because our expiration date has passed, it is now the 22nd of January. The buyer of the option no longer has the option. The option's worthless, which means we keep our 16 cents free and clear. But now we can write another option. But now the stock's at $55. So today, the current price was at $48.35. When we bought this option, the stock price at that time was at $48.35. We sold it about $12 away from the current price. If the stock's at $55, let's just round it and call it $10. Now we're writing a $65 option. So our risk of a covered call would then jump up from being sold at $60 per share, would jump up to being sold at $65 per share. Or if we stuck at the same $12, if it was at $55, now we're selling it at $67 per share. We have, or $67.50. They move in $2.50 increments. But still, the point is that if the stock were to gradually climb over the next few years, we could do this every quarter. Who's to say 3 years from now, 4 years from now, the stock's not trading at $75 per share? We've done this every quarter, and now we're writing $85 call options, giving people the right, giving the buyer of the option the right to buy our shares, which we bought at $49. We've been collecting dividends for 3 years. We've been collecting covered call premiums for 3 years. We've received so much back in cash, and we still have the shares, and now they're offering to buy it from us at $85. That is one of the real advantages for a dividend investor like this, is that they can really just juice up their returns. And as we add different dividend stocks to our entire portfolio, James is likely to try to position himself to be able to write additional options on a whole bunch of different positions, which also means because he's got $50,000 in his portfolio, he's likely to stick with stocks in $30, $40, $50 range, and maybe not necessarily go after a $300 stock we can only buy a limited number of shares, not 100.
Scenario number 2, that stock trends down over the next couple of years.
Yes.
You're making money off these calls the entire time.
Yeah.
Let's say you're in this long term, stock's trending down, but ultimately, like say for Alibaba, it trends down. You're in at, You're in at, let's say 400. You could have been making money the entire time, the whole way down, to mitigate those losses. But eventually, or at least you're confident eventually that Alibaba is going to eventually return to that point.
That's the hope.
You're making money. Yeah. You're making money the entire time. By the way, Alibaba not down. It pulled back today a little bit, but since October 1st, it was at like 140. Today, it's at like 170.
Yeah.
So,
depending on where you got it, you could be doing.
Yeah.
Well, that's the advantage of writing covered calls, is that the true advantage is that you can generate income. You could take a stock like Alibaba, which does not pay a dividend, and you could manufacture your own dividend out of it. If you wrote with our investor that has a whole bunch of cash and he's buying, he owns a whole bunch of SPY. SPY, they have a ton of options available. We could be doing monthly options to generate monthly dividends, and he could just keep doing it, sort of hoping that it doesn't get called away. And if it does, fine, jump in and buy more shares and do it again. Just keep generating that income. And I think that overall, depending on the portfolio, this could be a very powerful thing to use.
Yeah, and with Trevor, we'll get much more aggressive with these covered calls. He's going to be doing much closer to the money, trying to make a little more money off of that, squeezing the dollars out of it, as opposed to James, who was doing it, much further out. He's looking to hold on to Intel. He's looking to hold on to Intel, make that dividend, kind of juice up that dividend, that return essentially on the stock. Throughout his time holding it. The other thing I noticed, and you had pointed it out earlier when we were discussing before the live stream, is if you're looking to get out of Intel, if you bring up that call, the price again, the call prices again, if you're looking to get out of Intel, write a call at 50, and you're making what, $1 and change, $1.40.
Yeah, let's pull it up real quick. Wait, say that last part again.
So let's say I wanted to sell Intel. Let's say I didn't want to get it at, I didn't want to put the option out at 60 because I'm looking to exit my position.
Yeah.
Write that covered call at 50.
Exactly. You want to go real nuts, write it at 47.50.
Mm-hmm.
You know, if you write it at $47.50, you're picking up $2.50. Think about that, because the stock is trading at $48.35. I want out. I will let you buy it for me at $47.50 if you pay me $2.50. You know what I mean?
Yeah.
So essentially, you're giving up how much there? What? Not even $1.
Yeah.
You're giving up $1. You're collecting $2.50 to give up $1. Call it even rounded to $1. You're collecting $2.50 to give up $1. Hopefully it does. If you want out, hopefully it's a good way to. I've seen many investors at different hedge funds that I've worked with in the past. I've seen a lot of them that trade just like that. They jump in and say, okay, I want out. You can look at the pricing of this. Say, what if I sell the $40 call option for $8.30? You know, it happens to be $8.30 away. You know, okay, that doesn't make a ton of sense, but this one makes a ton of sense. $2.49, and you're giving up $1 to make $1.50. You can look at the pricing for each of this. This one, it is $4.35. You get $4.05 for it. That doesn't make any sense. You're better off just selling it now. $6.05, yeah. This is the only one that makes as good a sense as it seems. But think about that. I want out of it. Sell it right now. You know, and don't do one. This one happens to be 87. I pulled down this quote, 87 days away. If you really wanted out, you could buy one that was next week. A lot of these big companies have options that trade near term of the next 3 or 4 weeks, and then they break out to monthly after that, and they break out quarterly after that.
And the premium won't be as good for a shorter time frame, right? You're always paying for time.
Yeah, time value of money adds a lot. Plus, if you get a big day, Intel, I don't think Intel did bad today. I don't know. I forget.
They took a little bit of a shot. Everybody took a little bit of a shot today.
Well, we can really, if you want to sell at a higher cost, so you want to get more money for your options, there's a few things. They call them the deltas, not the deltas, the Greeks of options. There's delta, vega, theta, rho. But theta is the time value. So there's a formula behind how to calculate whether or not the theta is a good number for us. But basically, the longer you go out, the more it's worth. Vega is volatility, and all options become more expensive on high volatile days. So if you found a stock, Lockheed Martin got crushed today. It was down big, down like 10 or 11%, something like that. I own Lockheed Martin. I'm not too worried about it. But if we wanted to sell an option, selling it on a huge down day, even a huge up day, makes a lot of sense, because you're going to get a spike in the value of all the options tied to that underlying security. So if you're trying to sell the option, well, yeah, you want to do it on a highly volatile day. At a fund I used to work at, we would trade S&P options, and you'd wait for big, huge days, down days in the stock market. The stock market was down, the Dow was down 500 points, something like that. It's not as much now. But a few years ago, 500 was a big drop. 500 points down, and you'd jump in, you'd sell the call option on the S&P at that point. You do it way out of the money, because even the way out of the money, if Intel was down 5% today, hypothetically, you could buy, instead of a $60 strike price, you could probably get the same premium, but at $65. Something like that. Maybe the $60 gives you 40 cents, something along those lines. So you can change how you want to, you could change how you want to value you can change where you want to take your shots. Mm-hmm. If you did a $65, I'm happy with the 16 cents. Now you can buy it from me at $65. But again, the whole upside changes, because now if it gets called away, you do fantastic.
And we just went through the spectrum of the 101 of covered call options, all the way up to the masterclass PhD, master level class right there. So
later today, we'll be diving into how you calculate the Greeks. That's not true.
Now,
okay, hopefully you found that interesting, and if you're stuck with us all the way to the end of the video, I really appreciate it. I know that was a long video, but hopefully you have an idea of how these work, and we're going to be going over these more and more in all the different live streams going forward. So again, if you want to join our investing community, please click on the Patreon link in the description below. Come over, join the community, join us on the weekly investing live streams. We do a few different ones. We do discounted free cash flow on a bunch of different companies. We do the investment portfolios like the one you saw today. We do deep dives on stocks where I show you how to analyze different stocks so we truly understand them. So if you want to join, Link right here, link in the description below. Thank you, and hopefully I'll see you over there on one of the live streams. Thanks, I'll see you in the next video.